So, how is this financial regulation accomplished? It varies a little country by country, but generally the most powerful financial institution and regulator in most countries is what's called a central bank. And in the United States, we have the Federal Reserve, but in other countries they have, say, for instance, the European Central Bank, which handles the regulation of the money supply and banking sector somewhat. In Europe, we would have something like the Bank of Japan or the Bank of England in those two countries, or the Central Bank of China. And almost every country out there that I know of in the world has a central bank. The United States actually was relatively late to this game and didn't get its central bank till 1913. And if you go back historically in the United States, in the 1800s, the financial sector was pretty unregulated, and the U.S. had significant financial crises about every 10 or 15 years until people finally got fed up with it and decided, okay, we need to go ahead and regulate this stuff. The Federal Reserve has a sort of long, complex history attached to it. Remember that a long time ago, people were very suspicious of the federal government's power, and they wanted to avoid centralizing too much power in the federal government. So we have this sort of quasi-governmental structure. And officially, on paper, the Federal Reserve is not actually part of the U.S. government. And it has this structure that sort of is a mixture of federal control and local control. The local control is all kind of based upon economic activity and population as they stood in 1913. So, for instance, pretty much everything to the west of the Rockies is one Federal Reserve region because at that time, everything west of the Rockies was pretty sparsely populated. I think, if I remember right, Ohio gets its own Federal Reserve district all to itself because Ohio was a major population and industrial center for the United States at that time. Leaving aside sort of this long and complex history, the main policy-making board is the Federal Reserve Board of Governors. And these are appointed by the President and confirmed by the Senate. And they serve 14-year terms, the people on this. So, sort of my analogy here is they're kind of like the Supreme Court of money, in terms of the amount of political control and who has the control. And they also have these long terms, not life like the Supreme Court, but very long terms. And the intention here is to insulate them from sort of the day-to-day swing of political pressure, I believe. So these guys essentially are the main decision makers. And what are they trying to do? Most central banks have the following objectives. We're going to control the money supply. Not necessarily who has money, not control it in that sense, but the overall size of the money supply, how much is in circulation. To do that, we've seen that you need to have some control of the banking sector because the way banks behave is going to affect the size of the money supply. So central banks typically have some ability to regulate the banking sector. In the U.S., it's split a little bit. The Federal Deposit Insurance Corporation has some power. The Federal Reserve has some power. The Securities and Exchange Commission has some power over what are called investment banks. So it's a little bit fragmented. The Federal Reserve or other central banks have the function of what's called lender of last resort. And what this means is the Federal Reserve has carrots and sticks, essentially, to protect the financial stability. One, if someone is misbehaving, they can use their regulatory powers of enforcement to try and get them to stop misbehaving. But if something goes really wrong, and the system needs some sort of bailout or something like that, they do have these powers of lender of last resort. And essentially, remember, the Federal Reserve gets to print all the money. That's essentially its big superpower. And if you look at the money in your pocket, it will say Federal Reserve Note, because that is where the money supply comes from, and then sort of it is multiplied by the banking system. Last, central banks serve as the financial agent of their governments. So if the U.S. government wants to go ahead and get paid by another country or pay another country, it's typically going to have the two central banks of the countries talk to each other. So that's essentially what the Federal Reserve does. In terms of controlling the money supply, it has a couple of different main tools. The biggest tool is what's called an open market operation. And an open market operation is buying or selling U.S. government bonds in the secondary markets. So the Federal Reserve is acting just like any investor or bank. It's buying them out there in the open market. And the reason why this influences the money supply is if the Fed buys bonds, it does so with newly printed money. So, what happens is the private sector has fewer bonds, but more money. And at that point, there's more money in circulation. So the money supply has increased. What if the Federal Reserve sells bonds? This doesn't happen as often. But the Federal Reserve would sell some of the bonds that it had purchased on some previous occasions. What happens then is that, of course, the private sector has more bonds but less money, because when the Federal Reserve sells bonds to the private sector, of course, has to give the Federal Reserve money. The Federal Reserve basically takes this money out of circulation. So you can sort of think of the Federal Reserve as stashing that money in its vaults. Now, of course, it's all electronic and everything, but it's a good visual metaphor for you. So this is the Federal Reserve's main way of influencing the amount of money in circulation. So if you hear that the Federal Reserve is going to lower interest rates, one way of thinking about it is, if it lowers interest rates, we know that interest rates and bond prices move in opposite directions. If the Federal Reserve is buying bonds, that means we have higher bond prices because it's adding demand. And higher bond prices, again, we know that interest rates and bond prices move in opposite directions. Higher bond prices mean lower interest rates. So it's equivalent to say the Federal Reserve has lowered interest rates or the Federal Reserve has increased the money supply. On the other hand, if the Federal Reserve is selling bonds, then it's pushing down bond prices. And if it's pushing down bond prices,